we met, she started the Central Oregon Investor Network. And then we've come together since she created that business.
Because it's a real niche. I don't know of any other realtors in town doing that.
We keep hearing that. Yeah, I mean, there's a couple people, but the feedback that we get is that we are the most robust, that we have the most information and value to share. So we're happy to keep doing that.
Yeah, no, it's a great service.
Thank you.
Oh, thanks for saying that, Whit.
Oh, we can't hear you.
Oh, you can't hear me? Uh-oh, hang on. What's going on?
Yeah, we could hear him earlier.
I can hear you online.
You can?
Yeah.
Okay.
Oh, so you're fine.
So Sarah, you can't hear me?
Can't hear anybody. They can hear people online. You know the ideas. I can hear them before you can sign off and sign back on. Sorry, I know you're not necessarily tech help, but you're my tech help. You want me to try signing off and signing back on, Susan? You think that's a good idea?
Can you hear me? Can you hear me?
We're good now. We're good now. Thank you, Adrian.
Okay, you got me?
Yeah, we're good.
Okay, perfect. Good. Okay, I'm going to admit some people. We're already recording, so welcome. I'm so excited. I love seeing so many people in our office, and I know we'll have more people joining online. And we just want to thank you for joining us for our first meetup event of 2025. And we have a return guest speaker. We had Sugey Piedra speak at our August event about optimizing your short-term rentals. And so she was really focused on in that topic, talking about bonus depreciation and how the STR loophole works for investors. So we'll talk about that today, but we just wanted to bring her back because she is an incredible wealth of information, especially as we're entering tax season. And, there's just a lot to know about taxes when you're an investor, and there's so much you can find online that is half truth, and just it's hard to put it all together. So Sugey knows her stuff. She is based in California, but you have clients all over, right, Sugey?
Oh, she's muted.
Yeah, that's good. Yeah, so Sugey.
Yes, I do. Across federally licensed, so I do work with clients across the United States.
Excellent. Yes. So she's going to give you the skinny on stuff that's going to help you as you prep for your taxes. She is also available, as a resource for anyone that wants to talk to her. We've got a QR code for Sugey at the end if you're looking to find a new tax person. I think she's a great resource. So that is also available. So let's just get rolling. I think Sarah already did a quick intro for the both of us in the context of our new podcast, which we should have linked on here, but we'll add that next time. So we're both realtors in Central Oregon, and we focus specifically on helping investors. And so 5 years ago now, I created the Central Oregon Investor Network as a way to do that. And it is just this. It's this kind of event, this networking, getting people together, sharing our resources, learning from one another, and essentially helping ourselves and each other make more money passively from real estate investment so we can do what we want. And that just also brings me, if you're wondering why I'm not in the office, I am doing one thing that I want, which is I'm working from abroad. I'm in Malaga, Spain right now, which is Christy's home. So Christy, who's in the office right now, that's where she grew up. So I'm exploring her stomping grounds and got to stay at her childhood home and see life, from the Costa del Sol perspective, which has been amazing. And so, it's been a really fabulous trip. We're heading back this weekend to Central Oregon. So it's been a fun adventure. So that's just one example of what you can do when you have real estate investments and a business that goes with you wherever you are. Sarah, anything you want to add?
No, not really at this time. Thank you.
All right. Okay. Well, here is our topic, advanced tax strategies. And we just have our quick agenda here, and then we'll get into intros. So we always love for people to share who you are. And then also, just while I'm thinking about it, anyone that's online right now, feel free to put whatever contact information you're comfortable sharing in the chat. So maybe it's your Instagram or Facebook handle, your website. If you want to share your phone number, email, feel free to do that. This is meant to go beyond this event, so that you all can connect with one another and be resources to each other. So feel free to do that. We will be talking about advanced tax strategies. So we'll talk about maximizing deductions, leveraging depreciation, 1031 exchanges, and some other tax strategies. And then, I just think it's interesting also to hear, now that we're 3 days into a new administration, what kind of things can we expect from, new but familiar administration. So Sugey will talk about some of the things that she's anticipating we'll see over the next 4 years with regards to how it would affect us as investors. So we generally are not political. It's meant to just be more of a resource for those of us to plan. So let's hear from you. We love to just hear your name, your location. Are you aspiring or experienced? And anything that you're hoping to get out of today's meetup. And maybe Sarah, I'll pass it over to you if you want to get the room started.
Start in this corner and go around. Yeah.
Sure. Hi, my name's Caitlin Dunley. I'm an aspiring investor, and I have a short-term rental management company called Soul Path Properties, and I'm pretty new to Central Oregon. And I'm based in Bend, but serve many places in the United States and all of the state of Oregon.
John Hurwitz, just relocated here from Northern California a couple weeks ago with my family. I'm fairly experienced, just individual type properties that I own and with other operators, things like that.
Chris King, I'm here in Bend. Aspiring investor, also a self-employed engineer, doing some development stuff on the coast and looking for investment properties here in Central Oregon.
Hello, Ricky Vanderval, in Bend, aspiring investor. Goal is to network and learn as much as I possibly can. Generally speaking.
Go ahead.
Whit Ross. I'm an experienced investor for 38 years, looking to downsize. So, that's why I wanted to come to this class, learn about maybe minimizing my tax load, because I've done 19 exchanges. I don't want to do any more. So yeah, that's my story.
I'm Christy. I was born and raised in Spain. I've been in Bend now 18 years, and my family ran vacation rentals in Spain for most of my life. So it's definitely what I've been exposed to. I am a newly licensed real estate agent. Suzanne and Sarah are my mentors. I feel so lucky. And I'm an aspiring investor and learning as much as I can. And welcome to all of you new to the community. If you have any questions, I love connecting people, so please reach out to me. And that's my story.
Yeah, I mean, I'll just quick share about myself a little bit and what in my investments. I currently have 8 doors out of state that are long-term rentals in Missouri. My husband and I invested in a fix and flip project last year that we ended up keeping. So we've got 2 doors here in Bend. We're closing on another house tomorrow. So we'll have 3 rentals in Bend as of next week and a primary residence, and just kind of dipping our toes in all the strategies and learning where we really want to be spending our time and money. And that's slowly coming closer to home, I think. So we'll share more about that in the future. But.
Excellent. Well, thanks for sharing that. I'm going to just keep rolling with folks online. So I'm just going to go alphabetically. We'll go Avalon. Welcome.
Hi. So I am recently a transplant here in Bend, Oregon, but I do have rental property in Florida, and yeah, maybe want to move that to here or something, and just want to learn as much as I can.
Fabulous. Thanks for joining us. Dave Bednick. Oh, you're muted, Dave. There you go.
Sorry. Hi, folks. Dave Budnick here, local to Bend. Been here about 5 years, 25 years in real estate investments, bunch of different kinds of projects. Love attending these meetups and always meeting new people and hearing all the great stuff that Suzanne and Sarah have to bring to the table for us.
Thank you. And Dave is a past guest speaker on our meetups as well. So thank you, Dave. Then we've got Jenny Wang. Welcome. If you're talking,
If you're talking, Jen, I can't hear you. Move on though.
Okay. We'll move on to Jess. Jess Hexel, welcome. She put something in the chat. I don't know if she can.
Can you hear me?
Yep, we got you.
Okay. I tried to turn on my camera, but it didn't work. Hi, I'm Jess Hexel. I'm in Southern California, aspiring investor, and just wanting to learn about some of the tax stuff now that we've officially closed on our first property in Bend, thanks to Sarah and Suzanne.
Yay. We're so glad. So happy for you. Oh, I just lost all the people. Okay, here we go. All right. Julie.
Hi. Yeah. Hi, everyone. I'm Julie Schnedeker. I live in Bend. I've lived here for about 6 years. My partner, who's a Bend native, we just bought what we're considering an investment property in Bend because it's a single family home with 2 rental units with it. And so we close on Monday and we will suddenly go from never having been landlords to having 3 different rental units basically. And so I'm trying to learn everything I can as quickly as I can. So thanks so much for doing this.
Yes. Congratulations.
Thank you.
All right. Kylie Powell.
Hi, I'm located in Southern California. My husband and I bought our first short-term rental in Palm Desert, California, mid 2024. So this is our first tax season with a short-term rental. So just trying to learn as much as we can and be informed as we go into tax season. We're also looking to invest out of state next. So I feel like this will be a good group to get to know in case we ever are interested in Oregon.
Yes, we can help you with Oregon investing and investing in other places too. So both Sarah and I have investments out of state and can talk to you about the nuance of doing that well.
Great. Yeah, I know it's a little bit nerve-wracking thinking about it, but California is also, it's expensive, as everyone knows.
Yeah. Good. Well, welcome.
Thank you.
And then we've got Pete Shockley. Good to see you again.
Good to see you. Hi, everyone. My name is Pete Shockley. I'm a licensed property manager. I'm a licensed mortgage lender. And we invest right now just 2 single-family home long-term rentals in here in Bend, but 10 years in Colorado as well.
And Pete is a local lender. Yes, we'll give you a shout out, Pete. All right. And then we've got Tyler Bolton. Welcome.
Hi. Thanks everyone. So I'm in Silverton, Oregon. I go over to Bend quite a bit. So I'm aspiring for Bend and then also some other areas in like Arizona, Utah, and also Missouri from St. Louis originally. So trying to look in that market as well. But yeah, today, I started my LLC late last year. So really, just those initial startup costs and then just moving forward, hoping to get the first deal soon and then keep rolling.
Excellent. We're glad you're here. Okay. Well, did I miss anybody? Sometimes I do. No. Okay. All right. Then I'm going to turn it over to our fabulous guest speaker, Sugey Piedra from Prominence Business Services.
Awesome. Thank you, Suzanne and Sarah, for putting this together. I love hearing all of the, the investments in real estate. As you guys know, I'm a big fan of real estate. And I think a lot of it was born from reading Rich Dad, Poor Dad, but it was more of helping me connect the dots. I've been doing taxes for a very long time, and our tax system is just broken in general. I don't want to say that there's bad tax preparers out there or bad CPAs. It doesn't matter what kind of license or certification you have. It's going to be really about the person and how they are willing to take the time to really guide you, right? Because taxes can be very tricky, and a lot of the times people make it seem like, oh, they just input these numbers and whatever the computer spits out is kind of what you get. And so I was really tired of that system, and I wanted something different. But in order for me to be able to do that, I had to branch out and create my own firm. Every boss I've had, every CPA that I worked under just didn't see the value in consulting clients. They just wanted volume. And so with volume, it's you get 5 minutes and you're out. I need the next tax return. And just there was no connection with the client. And I was seeing a lot of missed opportunities. So in branching out to my, on my own, I read Rich Dad, Poor Dad, and I started to connect the dots and noticing how I knew tax, and there was these really cool strategies in real estate. But besides that, there's wealth building in real estate. There was, it creates what I call opportunity. And what I mean by that is every time you acquire a real estate property, it's options. It's like planting a little seed that in the future you can trim from. And so seeing clients when, let's say they're 80 years old and live in a $1 million home because it's grown in appreciation, but yet have a rice and beans budget because inflation's caught up to their retirement. And just noticing all these problems that I was like, if you only had a rental that we can like pull equity from instead of doing a reverse mortgage or selling your primary residence and paying Uncle Sam all these capital gains, like I just kept seeing like, oh my God, like these people need to know. And so I made it my, mission to share my passion behind all of this, put on events like this, talk in front of as many people that I can talk, and do podcast recordings and do everything that I can just to spread the message that there's so many cool things you could do with real estate. There's so many cool ways to build wealth behind real estate. And the tax savings that, you can create, to me, are just the bonus. But a lot of people feel that, they want to acquire real estate because of the tax strategies, but there's more to it. And this is why I want to kind of share some of this stuff, because you hear all this stuff on, TikTok, social media. And I don't want to say it's not true. It is true, but does it fit you? Is it designed to work for you? And that's kind of where I want to share a little bit of the clarity, and hopefully you guys can ask some really good questions at the end. So you can go to the next screen. So maximizing your deductions. The business here is me and my sisters. My sisters and I created this business to help clients really be able to kind of understand that anything and everything that is ordinary and necessary for you to run this business is going to be a deduction. So sometimes clients will call with some crazy, bizarre things that happen, and they didn't know it was a deduction. And so you want to just always remember that if it's ordinary and necessary for you and your business, then it is a deduction. And this goes across the board, any small business. It doesn't necessarily have to be a rental. But management fees, your interests are always typical, property taxes, insurance, and all this stuff. The repairs. I tell clients, I want to be able to see your supplies from Home Depot, from Lowe's, that you include the light bulbs, all these little things. Sometimes people are like, oh yeah, I forgot I did do that, and I didn't even include it in there, So keeping your expenses organized, having separate bank accounts for the rental property so that it's easy for you to go through these expenses at the time of tax filing, so that you could, create a really cool, income and expense report, so that we as your preparers can include that into the tax return. I see all the time missed insurance. I'm sure we all pay insurance and it's not cheap. But because you forgot to give it to your preparer and your preparer didn't take the time to ask you for it, now all of a sudden it's missed. Property taxes. Most of us pay twice a year for property taxes. Some of us pay it once a year, but most of us pay it twice a year. You don't understand how many times I only see one payment in there and they missed the second one. Mortgage interest. You feel like this is the given, that you should know this stuff, or this should it be in there, but sometimes one lender sells the loan to another lender, and you miss out 3 months, 6 months of interest because that number that was not in there. So you know, when we do a return, I review it with you line by line, but I also do comparisons. And I'm like, wait a minute, why was your interest last year, you know, 15,000, and this year it's only 9,000? Like, what happened, you know? And so you're like, I don't know. And I'm like, well, are you still with the same lender? Oh no, Rocket Mortgage sold my loan to, you know, whoever. So we're missing a 1099. So we want to look at things and make sure that things match. And you also want to make sure that, you know, if you look at this more closely on a quarterly, monthly basis, that you understand that we're missing things. I always give clients like an Excel sheet to kind of run month by month their numbers. You start to catch things, and then you realize that you ended up missing out on deductions because those things were not clear. Depreciation is a number that tax preparers, or, you know, when you're doing your tax return, is usually calculated and generated. But again, so many returns come to me, brand new returns, that are missing depreciation. Depreciation is something that clients are like, well, I don't want to take it because I heard I have to pay it back. That is true, but it's also a requirement. The IRS has said that we must take depreciation on our properties, or it's still going to be added back even if you didn't take it. So why are you leaving it on the table? And looking at depreciation, you're going to want to learn that. Let's assume that you redo. Well, let me think of something that is common. Okay, let's say you do like a plumbing repair, and you're like, should I depreciate it, or should this be capitalized in depreciation and depreciation, or should I expense it in a repair? We're going to look at it. We're going to evaluate that. The more you put in repairs and supplies, that is a deduction that you take, and you never have to pay it back. If you take something and you depreciate it, when you sell this property or when you recalculate anything, the depreciation is something that is going to have to be given back. The IRS wants us to recapture that and pay ordinary income tax on that at the time of the sale of the property. So if that expense, that repair of plumbing fits better in repairs than it does as a capitalized item, we want to make sure that we put it in repairs instead of depreciation. A lot of the times preparers will lump it all and just put improvements, and it goes in depreciation. Well, some of those things could have actually been part of the repairs and expensed, and you could have gotten the deduction and never had to repay back any tax on it. But because it was lumped in depreciation, now you're going to be subject to recapture rules. So just things to consider that, you know, nobody really talks about, but they're the little things that make a huge difference. Travel. I encourage my clients to have doors. I want you guys to have doors across the United States, every single state if possible, right? My belief is because of natural disasters, industry changes that I've seen happen. I had a client once have 60 doors in Detroit, Michigan. And when a few years back, when the car industry tanked, it became ghost town, and his properties lost a lot of value. He literally had empty houses that were getting vandalized because they were just empty. And he lost all of his fortune in that. And that's because you're centralized in one place. So I always advise to diversify your doors like you would diversify your stocks, and travel. Now you get to go to different places. You get to visit different places. And if you have property there, you can always, create a cool write-off for traveling to visit your property, to, monitor it, whatever it is. And now you get to take a write-off of that for visiting your property on that schedule. Some places have license fees. Some places have permit fees. You want to make sure that you look at all those expenses, and everything adds up. So when we are careless about our expenses, or we're messy with our finances, we miss out on write-offs, and then you just pay tax on dollars that you probably shouldn't. So with this, even though it sounds I'm already doing this, it's just pay close attention so that you could take advantage of every single little write-off that you have available with these properties. Okay. Next screen. So kind of discussed already what depreciation was, and I'm simply just kind of going over what it really is to depreciate something. When we have the building itself, you're not allowed to depreciate land, but when we're talking about the building itself or major capitalized improvements, we're going to have to decide if this is going to be something that is going to be divided over 27.5 years or 39 years. Short-term rentals fall under a different category that is technically not real estate. Even though it is real estate, it's designed for it not to be categorized as real estate. This is why there's really cool strategies behind short-term rentals. So short-term rentals, when we're talking about depreciation, it's going to go over 39 years versus 27.5 for long-term rentals. So why would we want to depreciate something over 27.5 years or 39 years when maybe we can do 5 or 7 or 15 years and maybe do bonus depreciation? So that's why when we do home improvements, sometimes it's better to look at what all is home improvements. What did you spend $50,000 on? Like, what's that number broken down? Because if I can put it in a 5-year or a 7-year category and depreciate it faster, I'm going to want to do that for you if that's what's, beneficial to you versus putting it all input 27.5 years. I've seen returns with like a garage door that was $2,000 divided over 27.5 years. And I'm like, really? That's like pennies, right? But you could have depreciated that over a lot less time and bonused it or taken it as a repair, depending on what it is. We always look at each individual item. But what I'm saying is dividing $2,000 over 27.5 years, I mean, you're barely getting anything. And now it's going to take forever for you to get the full write-off of that door. I don't even think that door is going to last you 27.5 years, right? So it's like things like that you want to consider. Can I take it and depreciate it over a smaller life versus 27 or 39 years? Okay. Next screen. So when we talk about depreciation, one of the cool things that has been happening in the last couple of years is in order for us to accelerate that depreciation. So we take advantage of it by using cost segregation. So depreciation is something that everybody wants because it's a paper number. What that means is you're getting to accelerate something that it didn't really come out of your pocket. Essentially, there's a loan behind it, or when we're talking about the building, maybe you still have a mortgage on this rental, but yet you want to depreciate as much of it as you can, quicker, so that you could get those write-offs. Well, the cost segregation studies came about, and they've existed before, but since 2018, when Trump administration was on board, what they did is they created some really cool tax IRS strategies that allowed us to take like the doorknobs, the light bulbs, the fixtures, toilets and all that stuff, and put it in a category where you can take 5 years, 7 years, 15 years and put them in those areas. And so now if you buy a house, say it's 500,000, maybe 100,000 of that is all these inner fixtures. Well, when they, in 2017, 2018, when they put those tax, new laws in place, they said anything that has a life of less than 20 years, you can bonus depreciate it, accelerate the depreciation, and take it in the current tax year. Well, it took a little bit for people to understand what that meant, but when they realized what that meant, that means that you could take that $100,000 of that property and accelerate that depreciation and take $100,000 deduction against your rental in the year that it was purchased. So cost segregation reports and studies went, crazy. Like everybody wanted them. Everyone wanted to do this on their properties because it was allowing you to take a chunk of this property that you would have normally divided over 27.5 years. And it's allowing you to take that deduction in that current tax year. So again, this is only something that is beneficial to you if you have other real estate income to offset, or if you're doing a short-term rental and maybe it flows to your W-2. If you're doing like real estate professional, which we'll talk about all those other benefits in a minute. But cost segregation studies, that's all they do, is they tell us this is building, this is fixtures, this is, I don't know, it goes into details with windows and molding and all this other stuff. And so it allows me to break it down on the tax return into different sections, allowing to use different IRS rules that says this is 5-year life, 7-year life, 15-year life. And then I can help and I could tell it, we want bonus on this, we want bonus on that. And if you go to the next screen, I talk a little bit about what bonus expenses are. Bonus depreciation is, and it will allow you to take it, instead of taking it over that 27.5 years, you get to take it all in the year that the property was placed in service. With those cost segregation reports, the other really cool thing is that if you bought the house, let's assume that you didn't even know about this and you're like, hey, can I take advantage of that today? And I'm going to say yes. What that means is if you acquired a house in, say, 2021, I can do a cost segregation report on that. And then whatever the report comes back, I can input it in your 2024 tax return. And I file an extra form and I tell the IRS, we missed it in 2021, but we want to take it today. So all of a sudden your 2024 tax return looks great, even though that property was purchased in 2021. So there is a way to still take advantage of that today, even though these properties were acquired in a couple years back. So yes, Suzanne.
Yeah. Okay. I didn't know if you could see my hand. So can you do that all the way back to properties you bought when the bonus depreciation was enacted in 2018?
Yes, that is correct.
Okay.
Yes. So as long as that rule applies, then that's when we look at this and say, hey, this may be beneficial for you. And so what I'm trying to do is squeeze the lemon juice out of that lemon so that we can continue moving forward. Just know, but you got to know the pros and cons of everything. Bonusing depreciation is a good thing, but it also has a bad side to it. And again, that goes back to recapturing depreciation. So my goal is not to just make you happy today. My goal is for you to understand what you're doing today and how it's going to affect you tomorrow. So what that means is if you tell me today you want to squeeze all this juice out of this lemon, but you're planning on getting rid of that lemon tomorrow, well, we got to take into consideration how recapturing depreciation is going to impact you. Are you going to do a 1031 exchange? Then you're just kicking the tax, the can down the road. So it's not that big of a deal, right? But if you're planning on selling it, then there may be some tax implications that we have to discuss that you need to be aware of. So again, it's realizing what happens to you, not just today, but tomorrow or the future, if you make the decision of taking this bonus depreciation on your tax return. Okay. And I think we could go to the next screen. So I mentioned a 1031 exchange. So the really cool thing about a 1031 exchange is, like I said, if you're going to do 1031 exchanges, what that means is you're simply exchanging one property for another property. Land, real estate, as long as it's within the real estate world, you can exchange one for the other. So sometimes I have clients that are thinking of, maybe downsizing, or they want to, maybe they start out. I'm in Southern California. I'm in the LA area, and it's really expensive to buy here. But I have clients that buy properties in other states, and now they're ready to exchange, say, 2 or 3 properties and exchange them for one property in California, or a duplex somewhere else, or multi-units somewhere else. So the cool thing about that is you're just acquiring what you currently have and exchanging it for something else. And there's no tax implication in that, as long as it's As long as a 1031 is done properly, there's no tax, because what you're doing is you're just exchanging one for the other. So if you squeezed all the juice out of that lemon and you're just going to exchange it for another one, then you still don't have to worry about the tax. The tax stays with the new property. You just kind of roll it into the new units. Okay. If you ever sell those units or that new property, then the tax is going to be released, and you're going to, the gains are going to be released, and you're going to have to pay taxes on that anyways. But the trick behind a 1031 exchange is that you exchange and you keep exchanging if you want to, but then when you're no longer walking this earth, that your beneficiaries inherit these properties at the new step up in basis, and then they can turn around and sell if they want, and they pay zero tax. So that was kind of the whole purpose of this exchange, is while you are alive here, you can still exchange and exchange and exchange or do whatever you want, but then not sell, because when you sell, you trigger the gains, and then there's a tax liability behind it. So a 1031 exchange is really cool. I heard somebody mention that, you know, they've done exchanges before and they're just looking for other ways. There's also ways that you can 1031 exchange into something called a Delaware statutory trust, which is an investment of still real estate, but you're no longer managing it. Okay. So you can exchange real estate into this fund. And then there's really cool things that you can do in there where you can actually break it into what's called REITs. And then in REITs, you can sell REITs every couple of years. And in other words, you're only going to be paying tax on what you dispose of that year, if that's something that you want to do. It's all about what is it that you're trying to do? What's the goal behind this? And does this fit you and your needs? And then we get the right team behind you to help you and, you know, achieve all of these changes. But 1031 exchange is a really cool thing that that helps all real estate owners continue to acquire more real estate. I like it when we take advantage of it to acquire more doors than we already have.
I have a question.
You could go to the next screen. I think it has more.
Yeah, this is Christy. So I believe, is there a time frame that you have to do that exchange within? 180 days, maybe?
Okay, yeah. So when you're talking about, so once you decide you do want to do a 1031 exchange, yes. You know, Suzanne just brought up the screen that talks about the rules behind it. So you want to make sure that you always reach out to a professional you trust so that you can get a good 1031 exchange company that will support you and help you through all of this as well. So a lot of the times, if you're going to do a 1031 exchange, I always tell clients, let's be proactive. Let's get the agents already in there. Let's get the team. Let's get everybody, because once we trigger it, your days start counting. And so you want to make sure that you don't want to start looking for a real estate agent when at day 45, like day one of the 45 days. It's like, no, you want to have your team behind you already, with something already in mind, with, you know, with a game plan, so that everybody knows where the clock is ticking. But because there are a lot of rules behind the 1031 exchange. Now, is it in the next screen that I talked about it, or because there's reverse 1031s exchanges as well that that we could take advantage of. There's see a delayed exchange. So there's different types of exchanges. This is why I tell you, having a really good 1031 exchange company alongside you will also be able to let you know, hey, you could do a reverse exchange, which means that you can buy the replacement property before selling the original property. So what are the rules behind that? How does that work? And so, it's really cool. There's still dates that you have to keep in mind. There's still a time frame that you have to meet, but a lot of people didn't know that this even existed, but it came to light with the shortage that there has been. A lot of people kept busting out of 1031 exchanges because they couldn't find that replacement property. And now it's like, no, go buy the replacement property first and then go sell the original property. And now you've done a reverse 1031 exchange, but you still need to have the escrow company and all that stuff, the exchange company already in the game so that they take the funds and you never touch the funds. Because the minute you touch the funds, you bust out of a 1031 exchange. So you want to have the team behind you already doing all of that. What if the sale of your replacement part falls through? So what happens is when you do a 1031 exchange, you identify, I think it's 3 properties typically, right? Typically, there's a couple different ways that you can do an exchange. There's actually, that's just the most common rule. But yes, if you identify those 3 properties and one of them falls through, this is why you have other backup properties as well. In case that were to happen, you can quickly jump into the next one. There's when you work with a real estate agent that's familiar with 1031 exchanges, they are also prepared to be like, okay, you need to have backup plan in case this doesn't work. Because if you don't have that backup plan, and I've seen it happen, unfortunately, you bust and you have to pay the taxes on that. A couple years back, Opportunity Zone Fund, which I think I mentioned at the end, was a good strategy. If you bust out of a 1031 exchange, you can invest into an opportunity zone, and that would help defer some of the tax. But they're not as lucrative anymore, just because they don't have the benefits that they used to have just a couple years back. But there's still ways. You just have to deal with the right team that can help you and guide you if that were to happen. But
and
we
the
don't
Delaware statutory trust is another like fail safe. Like if you have no other options, Tyler, there's these funds you can invest in to at least protect your money from capital gains.
To still do the Delaware statutory trust, you still have to be in the window. You just of the 1031 exchange.
Yeah.
So meaning, let's say you fall through and you just couldn't find a replacement property, but you're still within that I think it's the 45-day window of everything. Then you could say it could be even within 24 hours. Like let's say you're going to bust out of this 1031 exchange. Now you can invest into a Delaware statutory trust within that 24-hour time frame. I mean, it's that quick that you can get into something like this, and then it allows you to not pay the tax on that 1031 exchange or the sale of that property. Being aware of things like this, having your backup teams, having the research done on what a Delaware statutory trust and how that works. The Opportunity Zone funds, if you bust out of the 1031 exchange, you can still invest in it, even if it's after. So you could touch the money and then turn around and invest into an Opportunity Zone fund, and it still works and it defers the tax. But it was only deferring the tax till 2026. So again, they're not as lucrative as they were in the beginning because we're running out of time for those as well. So, but I'll talk about them a little bit more if anybody has any other questions on that one. So 1031 exchange, keep those in mind. There's a lot of really cool things we can do with those. And then.
Do you want to just keep cruising on to the next? Okay, we'll just go to STR tax benefits, accelerated depreciation, the juicy stuff.
So when I mentioned that the short-term rentals, there's some really cool strategies behind those because the IRS does not consider them to be just regular rental properties. So the really cool things about the short-term rental is that when we have, let's say we have a married couple and they are both working, they both have, W-2 jobs. Well, the IRS says that you can't take the deductions or the losses on that rental against your income because you both have jobs. Therefore, you can't be real estate professionals, even though sometimes people are considered that. It doesn't work. So with short-term rentals, because they're not considered by the IRS real estate in that sense, they don't fall under the same category, it allows you to take the deduction against your W-2. So a lot of people like that because what that means is you can offset other income with some losses that you generate. So imagine now applying and maximizing all your deductions, maximizing all the depreciation, doing cost segregation, accelerating all the depreciation you want, and doing the short-term rental on it. I mean, doing it all on a short-term rental. Now those losses that we just created, we squeezed all that juice out of that lemon. Now that can offset other income from other sources, whether you're a small business owner, whether it's W-2 income, it allows those losses to flow through to offset other income. So sometimes I tell clients, what's really cool about the short-term rental is that the reason it says loophole, okay, is because let's assume that you get a property, and I always tell clients, when you do proper planning, this can work. If you were to do this and get a short-term property, say in, I don't know, September, October, and you make it a short-term rental, which means that your guests cannot stay in that property for 7 days or more. It has to be 7 days or less. And you get it into an Airbnb style kind of a rental. You rent it a couple times throughout the rest of the year. So it meets all of the short-term rental loopholes. It's beautifully placed into where it needs to be so that it follows all the rules. You do the cost segregation. You do everything you need to do with it. Well, for that year, you get to claim it as a short-term rental. You take all the deductions against your W-2 income or your other income. And then January 1st of the new year, it's a long-term rental. You lease it out to somebody for the whole year. You no longer need it to be a short-term rental. It only needs to be a short-term rental for that initial year that you're going to take that deduction. And then the following year, the IRS doesn't care what you do with it. Now it can go back to being a long-term rental, and you won't be able to use those losses against your W-2 income or other income, but it's okay because you already squeezed all the juice out of it. So it doesn't really matter, right? Now you just want it to be as an investment, another asset, another, rental property that you own. So that's what the loophole portion of it means is because the IRS puts it in a different category, it allows you to take advantage of this for that current tax year, and then it'll move into something different the following year. So not always does it work, but this is why we do projections to make sure that before you buy or you do it, that it's going to work for you. And now you intentionally go buy the property that's going to fit what you need it to, to do for you.
I have a question. Say I had a primary residence and I wanted to turn it into an investment property. What's the timeline for me being able to take that and then roll it into a 1031? Like, how long does it need to be an investment property for before I can capitalize on rolling over that money?
So the IRS is never, the IRS doesn't have specifics on that, okay? It is something that in our industry is practiced, and they always tell you 2 years, all right? 2 calendar years. And we want to see it on your return for 2 years. Why that is because you're trying to show intent. So the IRS always goes to, what was your intention? What were you trying to do? And so if the intent, if we can prove intent, and this is why typically you'll hear that it's, the 2-year rule, is because you're trying to show the IRS that this was meant to be a real estate property, an investment property, but maybe the tenant stopped paying rent. Maybe the economy changed. Maybe you changed your mind and you don't want this property anymore because of X, Y, and Z. And then you did a 1031 exchange into another real estate property. Well, you want to just look at that and make sure that you can satisfy the IRS scrutiny of, was there the correct intention behind this or not? So to answer your question, typically the rule is 2 years, but I've had to do it for other reasons before that 2-year mark, as long as the client can prove intent that this was meant to be an investment property. And the client that had something like that there was a break-in, and after that they just didn't want to keep the property as an investment property in that area anymore. They felt that it was just not safe and they didn't feel comfortable, and so they were able to document all of that, and then they exchanged before that 2-year mark. But again, that was a special circumstance, which the IRS has rules for that, and so it met what it needed to meet, and we were able to do it. So everybody's going to be a little different, but typically it's going to be that 2-year mark.
Thank you.
So real estate professional status, okay? Real estate professional status is a strategy that's I mean, a lot of us want. A lot of us want to be able to mark the box that says we're a real estate professional so that we could take those losses against other income that we're earning somewhere else. Now, if you have a property, let's say you have multiple properties, a lot of you guys do, and one property is positive cash flow, so it reflects on your Schedule E, on your tax return positive as making money, and you have another real estate property that is maybe breaking even, and after depreciation, it shows losses, they'll offset each other. You don't need reps, you don't need anything special. They'll offset each other. Them appearing in the real estate schedules will offset each other. So that works out beautifully. What clients want to do is they want to be able to get those losses from the real estate and have it offset their W-2 or their income from somewhere else. Well, the IRS says if you have a full-time job, if you and your spouse, if married, have full-time jobs, you cannot be considered reps as well. Even though I do have professionals that work and that have real estate properties and on the weekends and throughout the, manage their own properties. So they do qualify for the 750 hours, but the IRS still considers them professionals in their industry. Let's say it's a teacher or an attorney or something. And they're like, no, you can't be reps because of that. So I tell the clients, you can't take that deduction against your W-2 or other income because you have those full-time jobs. Now, sometimes we have a professional married to a stay-at-home partner, and all of a sudden you're like, well, can we make that stay-at-home spouse manage the properties and take advantage of making that stay-at-home spouse reps so that they qualify for real estate professional? And now those losses can be released by the spouse to help offset the higher earning partner. Sometimes that works. And so we have doctors that call us all the time and be like, hey, I'm a high earning surgeon and I have rental properties and my partner stays home. Can we make this work? And so you want to follow the rules behind it. You want to make sure you're tracking your hours. You want to make sure you are documenting things. You want to make sure that you follow everything. And if you follow all the rules behind that, then yes, you can mark the box now that your partner is reps, you're the doctor, and now they've released all the losses that you've purposely generated by cost segregations and all this other beautiful stuff that we could do. And now your income drops because those losses are released against that other income. So it's a really cool strategy we could take advantage of, but it doesn't fit everybody. And you've got to look at things. Reps is something that in the past has been scrutinized by the IRS. It's been audited. So you want to make sure you have your documentations, that you're tracking your time, that you're doing everything you're doing. Now, sometimes we have spouses that are already in the real estate. They have a real estate license. So it's a little bit easier for them because their hours at work are considered real estate professional. So they're able to mark the box a little bit easier than somebody that does not have a real estate license. Contractors, if you're a general contractor, you can fall under reps. And so you can mark that box if you are out already working in the real estate world. And so they'll count those hours towards the 750 hours. So there's a couple other professions that fall under reps automatically. And so if you're already working in the real estate world, they will allow you to use those hours to count towards their 750 hours. So again, it's just getting educated on what are the rules and how you can make them work for you. I always tell clients, you want to be a duck, then you got to paint yourself like a duck, quack like a duck, walk like a duck, and I can mark the box that says you're a duck, and then it releases all those losses against your other income. But we just got to know what those rules are. Okay. On my website should be up and running maybe tomorrow or Monday. It'll have it downloadable with all the rules behind what reps category is. So that one is really cool. Okay. You can go to the next screen.
Answer Avalon's question.
There's a question.
Yeah, hi. I just have a question. I'm a little confused when you're saying that you can't take the losses against your W-2, because when you do your tax return, and let's say you have a $10,000 loss on your property, isn't that loss recorded on the before your AGI is configured on the front of the tax return? So it comes off automatically?
Only if you meet the rules. So there's 3 ways that that loss is released. You are correct where it appears. It appears above your AGI. But the only way it's going to appear there is there's 3 rules. One of them is if your income is under $150,000. Okay. So let's say your W-2 is 80,000, then the IRS will allow that loss to flow through. If you are reps, which means you have to check the box if you're a real estate professional. And the third one is if you're doing a short-term rental. Okay. Yeah.
Okay, so that makes sense because I've always just seen it. I mean, I do my own taxes on TurboTax, and it always has reduced my AGI when I have a loss on my rental. And then I'm just a little confused when you say short term. I don't ever remember checking a box saying whether it's short or long term. Is that determined each year when you do that return, or is that determined when you first buy the property?
No, that's determined by whatever it is that you're doing with that property. So
in that 1 year period.
In that 1 year, correct.
It could change. 1 year it's short term, and then the next year it's long term.
But if that happens, you have to make sure that the depreciation is moved from 27.5 years to 39 years, that you're following the rules of short-term rental, and then you're following the rules of long-term rental. If not, the IRS automatically makes it all long-term. They will not be playing the game of going back and forth if you don't have all of the things that in order. Like, let's say that half of the year is long-term rental and half of the year is short-term rental. It automatically falls under long-term rental. The IRS will say it did not meet the 7 days or less because you had tenants in there staying 30 days the first half of the year. Like, that's not how it works. They will automatically loop it into long-term.
And I would just trust that TurboTax is doing all this behind.
I don't know. TurboTax is only as good as the person inputting the information in there. In fact, every preparer, if your preparer knows and is inputting the information in there, that's as good as whatever it spits out. If they don't know, then that return comes out however it was inputted.
Okay.
Unfortunately, that's how it is.
Thank you for the clarification.
Yes, of course.
Question about the reps.
Yes.
So I'm self-employed as an engineer, but then I just started a development company. And so I'm going to be a developer as well as a general contractor on a development project. How would that look for reps qualification?
So we would look at exactly what it is that you're doing in that in your business, and if it meets the contractor rules for reps, then automatically your hours are counted towards that 750. Meaning, your real estate losses will offset the income that you're earning on that in that business, in that contracting business or developing business. So we just want to make sure that what you're doing there will fit that category. And if it does, which a lot of contractors unfortunately are not aware of it, it does. And you can strategically create losses in real estate in your rentals that will help you offset the income that you're earning in this other business, which it looks really beautifully if it's done correctly. So I would take the time to really look at that and see if what you're doing now fits that category, because you can take advantage of it for sure.
Okay. Thank you.
So another cool way that you can spread capital gains over multiple years is going to be by doing something called installment sales. What this does is it allows you to sell your property. You be kind of like the lender, the person holding the mortgage. And when you do an installment sale, you're only going to have to report on your tax return what you've made that current year. So instead of saying, like, let's say you sell a $500,000 property, right? And usually when you do an installment sale, there's other ways that you can design the loan so that there's like a balloon payment and things like that. When you do things like that with an installment sale, in the beginning, you can spread over the sale of the property. So even though you sold a $500,000 property, let's say in the first year, they're only going to pay you $50,000. Then that $50,000 is what gets reported in that 1 year. and the 450 is still spread over the rest of the year. So you don't have to report that as part of the sale just yet. So this allows you to break down this sale of 500,000 over multiple years until the loan is fully paid for. So I like this because we can strategically plan. Sometimes there's clients that, you know, have had rentals for a long time, or they're fully paid off or something. And they're like, you know, right now I want to sell it, but I'm not going to retire for the next 2 or 3 years. And I'm like, well, you can always do an installment sale now and then make it to it where it has like a balloon payment, or the client has to refi out of this loan in, say, you know, 5 years, and you'll be retired by then. Your income will look different. And so then what it'll do is you do an installment sale until that period, and then where they balloon pay you, and then all of a sudden the tax just is broken up between all of those years, and it just turns out to look a lot better for you. Installment sales are something that just take a little bit more planning behind it, see if that's going to work for you, if it's going to fit your goals, but just know and be aware that it is out there and that you could do something like this.
Yeah, and just a comment, in the real estate world, that as a seller, that looks like seller carry financing, being the bank, right? Or potentially even like coming up with a lease option for renters who want a lease to own as well. But Sugey just confirmed, like, this also eliminates your ability to do a 1031 exchange in the future, correct?
Correct.
Yeah.
Yep. Yeah.
I mean, 80% of them go back to the seller.
Yep,
that is true. So again, there's some pros and some cons. So it's just important to know that they exist. In my opinion, is know that there's sometimes options out there that you're not, you know, that people are not familiar with because they're not common, but they're out there. Next screen. The next screen is just briefly. It's really hard to put case studies together for when we're talking about taxes. In my opinion, is, you know, the reason we offer introductory calls and discovery calls is because I tailor my recommendation, my advice specifically to your situation. Knowing about all this stuff is great and having awareness, but how does it really impact you and affect you is a game changer, in my opinion, because now you have you know, more knowledge, more specifics on you and how some of these strategies can help you or hurt you. And now you know how to intentionally go after the next property or your next money, you know, move so that it benefits you. But I'll do my best with this case study. So really quickly, this is a taxpayer earning about $200,000 annually in a W-2 income and invests in, say, stocks only. Okay, so there's it's just earnings. Next screen. So without any real estate investment, the income is $200,000. So his taxable income is going to be $200,000. This is obviously no deductions beyond the standard or itemized deduction. So the federal tax that will be owed on something like this would be, say, $38,300. Okay. The next screen. Same scenario with only earning $200,000 and invest in real estate. Okay, so this is going to be somebody that is going to be able to claim, say, reps, or is going to be able to take advantage of one of the strategies we talked about. With the property of $500,000 and $20,000 in expenses, if you, I'm sorry, with $20,000 annual net rental income. So this person's getting their W-2 plus $20,000 of rental income every single year. So if you look here, their total income is $220,000. Next screen. They get to deduct on the rental their mortgage interest, their property taxes, depreciation, and then repairs. So their total deductions for that year is $47,182. Next screen. So they're going to have a loss of $27,000. So in this scenario, the $27,000 is going to be able to go against their W-2 income, leaving them with taxable income of $172,000. So what that does is it allows to bring that taxable income down, saving them about $7,460 in taxes. But what I tell clients is you got to look at this beyond just the tax savings. You have another asset. another asset that you could potentially dip into if you needed to, another asset that can, create extra cash flow, another asset that's appreciating value over time. So your overall picture just looks better when we have real estate in our portfolio, even though, yes, the tax savings is still $7,400. I look at it beyond that, especially because when we're doing something, this was just a straight, simple scenario. But if I were to do a cost segregation, accelerate depreciation, or things like that, this tax savings could have been a lot more significantly. And if that's the case, then that is also another way to use that tax savings and deploy it to go get out more real estate. So you're always going to hear me say, with the tax savings, now you can invest more in keep more money in your pocket, but turn around and invest it in more so that you can continue to do these strategies year after year. So again, just a simple case study, but I encourage you guys.
That case study. Does that only apply if you're the sole owner of a property and you're not doing this with a partner, like a single member LLC, or does that not matter?
So if you have a partner, it's just going to be, obviously you and your partner are splitting the reporting of the property. So you would get the 50% of, or whatever your percentage of ownership is, that's what you get to report. And then they would get to report the other portion of it. It doesn't matter if it's an LLC or not. And if it's an LLC, it's a partnership return. So you're going to get a K1 with your share of losses, and they're going to get a K1 with their share of losses. So it's still going to turn out to be the same. It's just whatever percentage you own.
Okay, thanks.
Mm-hmm. Okay, so I mentioned this, I think, a couple of times, additional benefits to owning real estate. I mean, Sarah, Suzanne, you guys can always elaborate on, the building the wealth through equity, how all this is just, real estate time and time again has outbeat a lot of, other investments. When I look at my clients' portfolio, I like them to have, their stocks, their investments, their retirement accounts, and all of that good stuff. But I also want them to have a piece of the pie in real estate. I believe that it just creates that much more opportunity for you in different ways. And when we are still working and we're still young enough, and maybe we just don't need the money, when we can turn around and make that rental income cash flow and put it into some other investment portfolios, you have more assets growing for you and your benefit. So sometimes I have clients that don't need the cash flow that's coming from their property, or it's just not a lot, right? So I tell them, grab it and put it in your kid's 529 plan. Grab it and put it into an insurance policy. Grab it and put it into a brokerage account. Let those assets grow, consistently, so that your overall real estate investment turns into multiple assets. And that's when you really, benefit from all this, because today we're young. Today we feel great. Today, we have all this opportunity in front of us. But when I have sat in front of, with clients who are retired, or they're, maybe 80, and all of a sudden they lost their partner, or they got injured, they fell, or they live in a house that just doesn't fit them anymore, and they need to downsize, and they don't have a lot of options. My heart breaks when I have to present to them, now Uncle Sam wants a chunk of the sale of your property. So you thought you can, downsize and sell this house and go live in an assisted home, and all of a sudden I have to reduce your wealth because that you have to pay Uncle Sam before you can use any of those other funds. And so to me, that's devastating news for them, because it hurts their lifestyle now. When I have clients that are like, no, I'm great, we're going to retire and we have all these plans, but then something happens. It's called life. You get hurt, your health deteriorates, something tragically happens, and all of a sudden you're looking back at everything you own or everything you have, and you're very limited. And that's when I started to tell clients, we have to change what we currently own and create more assets that we can dip into, that we can trim from if we need to. If we don't, great, because you can always have your family inherit this or organizations inherit this. But when we need it, we want to be able to have those options to look at and be like, okay, I don't have to go against my own primary residence or my own savings. I can actually go and trim from other assets that I've grown over time if you need them. So there's a lot of benefits and potential to real estate, but overall, just looking at wealth building opportunities. Next screen. So with the new administration, what's changing, what's happening? Well, first of all, I think you can go to the next screen. I don't know if Trump's going to abolish the IRS, but maybe he is. I don't know, right? He's been talking about getting rid of the current, internal revenue structure and all this stuff. Even if that's the case, I don't think taxes in general are going to go away. I mean, he's talking about a flat tax, all this other stuff. We got to see what's going to happen with all of that. When, last term he was in the House, it was the bonus depreciation. It was a lot of cool tax strategies that were implemented. And a lot of people did not take advantage of them in the first 2-3 years because, I think social media now helps a little bit more, but in the beginning, it's like not a lot of people were aware of things that you can do. We like the fact that we can still take advantage of bonus depreciation, even though the property was purchased in prior years. We can still implement it and grab it and put it in today's tax return. So that's really cool. But this is going to phase out. This now is bonus depreciation has been reduced to 40%, and it's supposed to be suspended for 2026. But the good thing again is if you bought a property in say 2022, I can go back to 100% bonus depreciation for 2022 if you didn't take it, and we can take it in the 2024 tax return or 2025 tax return. So we could still take advantage of that. But this bonus depreciation is due to expire, and it'll be gone after this year. So we'll see. I'm hoping that they bring it back. They put it in place. They saw the benefits. They saw how a lot of individuals were out there purchasing so that they can take this bonus depreciation. So maybe they see the benefit in that and they bring it back. There's talks that they will, but nothing has. There's a bill out there right now and that is waiting for final sign off. So hopefully it's approved and we can go back to 100% depreciation. But for now, it has not been renewed.
We have one question, Sugey.
Yes.
You mentioned depreciation. You have to pay that back basically when you resell the property and so on. How does depreciation work, and including the bonus depreciation? How does that work if you demolish a building and rebuild something new?
So just because you demolish something and you build something new, that still stays with the original structure. I mean, it's like buying a car and then buying another car in a sense, right? As long as it's still there. So you're still going to be able to take that. Now, the new building that you do is going to have its new expenses, its new whatever, well, I don't want to say expense, but the new cost of rebuilding it, right? So that's still going to add on to it to depreciate. It's going to start a new life. So that's going to be a new set of depreciation. But the old one, you're still just going to be able to take a portion of it every single year. As long as you don't sell it, you don't have to pay it back. But once it's sold, it's triggered. And usually, well, with us, every tax preparer will have a schedule, and it'll tell me how much depreciation you've taken up to this point. So that's why when you come into my office and you're like, hey, I want to hire you, I'm like, okay, you got to bring me all the depreciation schedules that you've had, because I need to go back and make sure that my beginning number is the number that was lastly reported. And sometimes I find mistakes, so we fix them or whatever, but we want to make sure that we have a good number for the beginning number, because once you're my client and we move forward and you're like, hey, I'm considering selling this property, I want to be able to give you the correct information and say, okay, you can sell it, but you have $200,000 worth of depreciation that you've taken over the past years. And now this is going to cost you some tax, and you want to know what that is, or how can we offset the tax on that recapture of depreciation. So there's ways that we can offset it as well. And we would just be able to work out that case and brainstorm on what's going to be the best way for you to handle it. Okay. Another thing that's set to expire is going to be the lifetime the estate tax exemption. So right now, a lot of people call me and be like, "Hey, I'm gifting, my child $50,000 or $100,000 for the down payment of their house. How is that going to be taxed? How does that work?" So we are allowed to gift. I think it's $15,500 every single year without any tax implication. But when it exceeds that, we're supposed to file a gift tax return just to notify the IRS that we gave somebody more than the $15,000 limit, and that we would be subject to tax for gifting that money. But as long as your estate or everything falls under that $13 million, then there's no tax. But you still have to file a gift tax return to notify the IRS that you're gifting your child or whoever $100,000, and then they just keep that on file so that if you ever exceed that 13 million, then the tax will kick in after that. Since this is set to expire, they're talking about it being cut in half. So, maybe it's going to be now the state exemption is only going to be 7 million. We don't know yet, but that's what there's talks about, that it's going to be cut in half. So curious to see what happens. But again, this was put in place by the administration when it was, when it was back then. So hopefully they keep it, and then it stays in place. But not a lot of people, are worried about it. But there's also a lot of people that make a lot of money, and they just want to make sure they don't exceed that, so that they're not stuck with a gift tax for gifting money over that threshold. The next one, I don't know if there was another one.
There's some state stuff, and then the Corporate Transparency Act, but
okay,
I might skip over that since it's currently not required.
Yeah, but it may be coming back, so we don't know yet. And so, again, there's a lot of things that are set to expire, and hopefully that will be brought back with this administration. But there's a lot of changes that are happening. He is moving fast. You guys saw all the changes that have happened in just the last couple of days. There's a lot of incoming information for us. We're on standby. Nothing has been concrete for us just yet, but I'm excited, and then I'm not. And so I don't know, every day, every hour is, crazy, because there's just a lot of information coming through. But I'm hoping that because some of these were put into place, and they benefit a lot of small businesses, a lot of clients that own real estate, a lot of individuals that took advantage of this. I'm hoping that they reinstate them, or they extend them, or that they put something else that is friendly for us to use and take advantage of us, for us that hold some real estate. So we'll see. But right now, nothing has been, announced that I can give you guys for sure on, even though the IRS is due to open next week, which is crazy, but whatever. Next.
Jess had a question in the chat. Are closing costs such as insurance prepayment added to the cost basis, or are they considered expenses that can be deducted against income? That's an expense, right? That doesn't add to your basis, correct? That's just taken as a deduction in the year in which the expense.
So closing costs are loans. Okay, so there's certain closing costs that are going to fall under the life of the loan. So closing costs, let's assume that there's I don't know, say it's $2,000. You will have to depreciate that over the life of the loan. So it could be 30 years if that loan is for 30 years. But let's say you refinance the following year, then I would be able to take that full 2,000 in the year that you close and you refinance that loan, because it wasn't 30 years. You only had that loan for 1 year or 2 years or whatever. So I'm able to take that in the year that you refinanced out of that loan. And now the new closing costs for the new loan would go over the 30-year life of that loan. So there's a chart that I have that has that I plug in all of the charges that you get on an escrow statement. And then that's how I determine how much is loan related, how much is going to add to bases. And so that allows me to determine what's the life of each of them. But I always want to put your loan costs in that loan category, because if you ever refinance, I want to be able to take those and not lump them in the property for 27.5 years. I want to be able to take those the year you refinance out of that loan, so that we get that deduction a lot quicker. Awesome. And I think the last screen, is it just one more screen? I think I've touched over this one. So I think the last one
was corporate transparency.
Yeah. So if this is just for all of those that have any type of LLC, any type of corporations. The federal put this in act and then they kind of took it away. And so right now it's been suspended. But it's something that you want to keep an eye out, because you want to report to FinCEN the ownership of your entities to avoid, it's like a $500 a day penalty or something really steep. And so right now they've suspended it. And so a lot of people are like, well, do I really have to do this? Do I not have to? It moves really quickly. It was suspended and then it was reenacted, and they said it was due December 31st. Then they suspended it again, and then it was reenacted and they said it's due January 13th. And then it's been suspended again. So one of those things that, you know, it comes and it goes, but when it comes back, they're not going to give us a lot of time, in my opinion, because they've already like given us time, extended it, and vice versa. But right now they're being sued on the fact that, you know, this is personal information. We shouldn't have to disclose it, but we don't know yet. So just keep an eye out if you haven't filed the FinCEN form, that if this comes back, you know, you're going to have to do it. And if you just want to do it and get it out of the way, then you can go to the FinCEN website. It's free. There's no fee to fill it out. And then just put on there the information. They just want to know where you live, who you are, you know, the owner of the LLC. Now, I've hired an attorney to do mine just because I wanted to make sure that, you know, everything was done properly, but you don't have to do that. You could do it yourself. But just know that this is something that moves really quickly. And right now it's been suspended, but you never know if it'll come back. Awesome. I know that was a lot of information, guys. Thank you for your patience. We try to put all this stuff into these slides and in this topic, but if you guys have any questions, you know, let me know. We can always, you know, you can always reach out to us and schedule a free intro call where we'll kind of go over some of your needs, and then schedule a discovery call. It's going to be free. I try to give as much information as I possibly can, but know that each and every one of you will have a different result with each and every one of these strategies.
You have time for one more question?
So hey, we've got another question. Whit's got a question?
Yes.
Is there anything about the Fidelity separately managed account?
The Fidelity separate managed account?
Yeah. Fidelity is the only bank that offers it, and only certain financial planners offer it. But it's a way to get out of real estate without doing a 1031 exchange, make your assets more liquid, and it's a fund that they set up, and they generate enough losses through short selling that, like, you know, in your first year, let's say, and the minimums are $1 million, so it's sort of for, you know, more experienced investors. But anyway, see, the first year with $1 million in that account, you're going to generate about $650,000 in losses. In the second year, about $1 million. And so if you say I sell my duplex and I have $500,000 in gain, in the first year, boom. It's a great tool. It's the first year. Well, I guess it's just newly released. The minimums in the past have been in the billions, so that's why the Jeff Bezos people of the world get ahead, and the little guy didn't. But now they've lowered the minimum down to $1 million, and it's a really popular thing that just started a few weeks ago.
No, I haven't heard of that, and I'll definitely look into that. It sounds very interesting. But you're right. There's some things out there available that it just depends on the income thresholds, right? But I'll definitely look into that. I know that I believe there's I don't know if it was New York Life has an annuity that you can also do something similar with, like a 1031 exchange. You can exchange into it, and then over time it's like an annuity. They'll be just paying you money off of that real estate sale versus you getting it all up front. So it's a way to
know about it. Just Google Fidelity SMA or separately managed account.
Okay. I'll definitely be doing that. No, thank you for sharing that.
You don't need to exchange because that passive loss is going to cover all the gains.
Right, the gain. I see what you're saying. Yes. So you're gonna sell, creating a gain, but the SMA is going to create the loss that you need to offset that gain.
You're still going to have the gain, but you're going to have more than an awful lot. Well, maybe not the first year, but the second year. If you want to do it the first year, you want to close as close to January as possible, because they harvest the losses every 4 to 6 weeks.
Okay.
And there's only 2 financial advisors in Oregon that offer this product.
Yeah, it sounds like it's very specific.
What's that?
It sounds like it's very specific. Like that's why only a few financial advisors know of it or are selling it, is because it's very specific. There's going to be certain criteria. So that's really cool. Thank you for sharing that.
Well, thank you, Sugey, for sharing all of your amazing expertise. I know there were some great nuggets in there. It was fun to watch the chat and hear all the questions. So everyone, you have Sugey's contact information here, QR code, email, phone number, all the things. So reach out to her. We will have a replay of this on our YouTube page and on our Facebook page as well. So you can catch it if you didn't write down Fast and Furious, all the great tips she was sharing. You can take it at your own pace. And just want to say again, thank you, Sugey, for sharing all your wisdom with us.
No, thank you guys all. Thank you for being here. I know it's always a long presentation when we do these, but there's just a lot of stuff in the tax world, real estate world, but it's all really fun stuff. So thank you all.
All right.
Thank you.
Bye.
So we share the chat from this as well on our Facebook page with information. If anybody wants their information shared on the Facebook page, please feel free to sign in and we'll share it with everybody else so people can connect. Otherwise, don't worry about it. Just that's there if you want it.